In Florida's property insurance market, homeowners are facing a troubling situation. Soaring costs, limited options, and potential consequences for the housing market have raised significant concerns. Today, we delve into these challenges and explore how they may impact housing affordability. Let's uncover the realities of Florida's property insurance landscape. Floridians are already grappling with soaring home insurance premiums.
The letter went from $2,800 approximately to over 15,000.
But the situation may worsen as the market experiences further instability. The average yearly home insurance premium in Florida has skyrocketed to about $6,000, representing a staggering 42% increase compared to last year. This surge far surpasses the national average annual premium of $1,300. Such exorbitant costs are putting immense pressure on homeowners and threaten to erode housing affordability. The departure of insurers like Farmers Insurance from Florida not only limits options for homeowners, but also contributes to rising costs. As the pool of insurers shrinks due to decreased profitability, the remaining companies have to bear a higher risk burden, which often translates to increased premiums for policyholders. This trend places a heavier financial strain on homeowners, making it increasingly challenging to maintain affordable housing. The repercussions of limited choices and higher costs can be felt across the entire housing market. With the private insurance market contracting, more homeowners are turning to state-run insurer, Citizens Property Insurance Corporation. This reliance on a single insurer poses significant risk and raises concerns about the long-term stability of the insurance market. As Citizens accumulate more policies, the burden on its reserves increases, potentially leading to a depletion of funds needed to cover claims. Since Citizen is backed by Florida's government, that means that the burden will fall onto the state taxpayers and insurance policyholders of all other kinds.
The issue comes in is if we have, a storm season where 1 to 3 storms hit the state of Florida pretty well, and it wipes out all of Citizens' reserves.
That means if things got bad enough, the state of Florida can increase the rate on every kind of insurance policy in the state up to 30% for several years. This includes renter's insurance and auto insurance. This is especially worth noting since we are on the brink of hurricane season. This additional financial burden can strain households and reduce disposable income, making it even more challenging for potential buyers to enter the housing market. The combination of higher insurance costs and surcharges have a domino effect on housing affordability and accessibility. The instability in Florida's property insurance market has far-reaching implications that extend beyond the realm of insurance. Rising insurance rates and limited options can deter potential buyers from entering the market or force existing homeowners to sell their properties. This decrease in demand can exert downward pressure on housing prices, potentially leading to a decline in the overall housing market. As the market cools, homeowners may find it increasingly difficult to sell their homes, trapping them in a cycle of declining values and limited mobility. This unsettling trend is not unique to Florida. Across the country, insurance companies are boosting rates, limiting coverage, or even pulling out completely from regions susceptible to natural disasters. California and Louisiana have struggled with insurance markets after extensive wildfires and hurricane damage, while Colorado has seen rising premiums due to wildfire threats. The consequences of this insurance market shift are already being felt by California homeowners. Some are unable to obtain coverage, and a shortage of new policies could make it even more challenging to buy a home. Prior to the crisis in Florida, it was believed that the U.S. housing market was a tale of two coasts, with the West Coast experiencing plunging home prices while the East Coast saw a surge. But now, with the Southeast beginning to show weakness, this would be the second domino to fall in a series of housing market black swan events. Economic volatility plays a crucial role in shaping the housing market's uncertainty. The past few years have been marked by unexpected events and surprises that have impacted economic forecasts. America chief economist Bill Adams highlighted the challenges faced by the economy, stating the economy has been very volatile in the last couple of years, and the economic forecast, just in general, has been hit by more surprises than in a stable period. This volatility contributes to the divergence of opinions and forecasts we observe. Regional differences can obscure the overall picture of the housing market. While national averages provide a broad overview, they fail to capture the stark variations between regions. Housing markets can differ significantly from one area to another, leading to contrasting viewpoints. It's crucial to consider the unique dynamics and factors at play in each region to gain a more accurate understanding of the housing market landscape.